Assalamualaikum warahmatullahi wabarakatuh. I'm Nabila Aksa and my student number is 2031151. Now I will explain the material that I have learned in the course of Strategic Financial Management. For the first meeting, the lecturer has been explained about capital structure. So, what is the capital structure? Capital structure is an important element in the company. This element is used to see the composition of debt to equity in a company by comparing long-term debt with equity. The management of this capital structure to combine permanent source of fund used for operational activities, which will maximize the value of the company. In the other words, good management of the capital structure indicates that the company is in good financial management. Capital structure theory. There is four capital structure theory. The first one is theory or Modigliani-Miller theorem. According to the Modigliani-Miller theorem, a company market value is correctly estimated as the present value of its future earnings and underlying assets, and it is independent of its capital structure. The thesis contends that, under certain assumptions, it is unimportant whether a business finances in expansion by borrowing, issuing stock shares, or reinvest earnings. The second is trade-off theory. According to the trade-off theory of capital structure business leverage is calculated by weighing the advantage of debt in terms of tax saving against the cost of bankruptcy. The theory was created at the beginning of the 1970, and despite a number of significant obstacles, it is still the most widely accepted explanation of corporation capital structure. So we can conclude the cost of bankruptcy, which raise a more leverage, is utilized, are ignored by theory. Tax benefit offset bankruptcy expense at modest leverage level. High levels of leverage result in bankruptcy costs outweighing tax advantage. And there is a capital structure that balances that advantage and disadvantage. The next is signaling theory. What is signaling? Signaling is the process of starting of trading position utilizing insider knowledge. It happens when an insider divulges significant information about a firm, causing those who would not typically have access to insider information to purchase or sell the company stocks. Outsider interpret the insider activities as a market signal. According to dividend signaling theory, when a firm announces an increase in its dividend payout, financial analysts and investors interpret that as an indication of promising future for the company finance. The dividend signaling theory does have some support, notwithstanding the doubts of many analyses. Increase in dividend payment typically signal a promising future for the company's finance and share price. A decline in the dividend payment might be a sign the company's finance will experience difficulties. In a sense, the dividend signaling theory contends that more prosperous business will be those that pay the biggest dividend. Next is pecking order theory. According to the pecking order theory, business prioritize their financing option or internal financing to equity financing and reserve equity financing as a last resort. Priority is given to internal resources And when they are exhausted, debt is issued. When it makes no sense to do so, equity is issued. According to this theory, organizations follow a hierarchy of financing options and favor international funding when it is available. If external financing is needed, debt is favored above equity. In this theory, we can conclude because there are no flotation charge or warning sign at first. Business initially use fund that they have created internally. The second is debt is issued when additional money is required by it has lower flotation cost than equity and doesn't send out unfavorable signals. And companies that is a sell in if extra money is required. Okay, we jump to the next slide. Next slide is about the determinant of capital structure. There is sales ability, asset structure, operating leverage, growth rate, profitability takes, management attitudes, and market condition. We jump to the next slide. The next slide is about the cost of capital. What is the cost of capital? Minimum rate of return or profit that a business must achieve before creating value is known as the cost of capital. The accounting department of a company computes it to assess financial risks and determine whether an investment is appropriate. The cost of a capital is the return a business must obtain to cover the expense of capital project, such as buying new machinery or building a new structure. According to the company's preferred or existing capital structure, cost of capital includes the cost of both equity and debt. The weighted average cost of capital is this VACC or WACC. Investment decision made by a corporation for new initiatives should always result in return greater than the cost of the capital utilized to finance the project for the company. And otherwise, the project won't give investor a profit. The next is about dividend policy and stock repurchase. So, in dividend policy and stock repurchase, it's explained by four theories. The first theory is dividend irrelevant theory. According to the dividend irrelevant theory, a company's dividend payment don't raise the stock price of the company. The dividend irrelevant hypothesis contends that dividends are detrimental to firm sign the money would be better reinvest in the company. And when firms take on debt to honor dividend payment rather than paying down debt to enhance their balance sheets, the notion holds substance. The next is bird on the hand theory. The bird idea was created by Myron Gordon and John Lindner as a counter-argument to the Modigliani-Miller dividend irrelevant theory. According to the dividend irrelevant theory, investors are unconcerned about whether their reward from stock ownership come from dividend or capital gains. Stock with significant dividend distribution are sought after by investors and as a result attract a higher market price according to the bird in hand principle. Some example, for example, is Coca-Cola or KO is a dividend paying company that fits into a bird in hand salary based investing plan. Coca-Cola began paying a regular quarterly dividend in the 19 and 20, according to the firm. Furthermore, since 1964, the corporation has increased this payout every year. The next is tax effect theory. When the investment time horizon and other factors are examined, the tax differential theory of dividend policy holds that shareholder prefer equity appreciation over dividends, since capital gains are effectively taxed at lower rates than dividends. As dividend payment are fixed rather than fluctuating, corporations that hold this position typically have lower targeted payout ratios or long-term dividend to earning ratio. Next is signaling theory. Dividend signaling hopes that dividend increase are an indication of a company positive future performance, and that only management in charge of positive potential will over such as a signal. Increasing a company dividend payout may indicate that the stock will perform well in the future. According to the signaling theory, corporations that pay the greatest dividends are or should be more profitable than those that pay lower payouts. We jump to the next slide. It is about capital market and IPO process. So IPOs gives company the ability to raise fund by selling shares on the primary market. Companies use investment bank to sell demand and establish the IPO price and that among other things. The first public offering of stock by a private corporation, the producer by which an unlisted company can be listed on the stock exchange by offering its securities to the public in the primary market is known as an initially public offering or IPO. The purpose of an IPO may to expand the company present activities, to establish new initiatives, or to any other purpose defined by the company in its over document, or simply to list its existing equity shares by diluting the position of existing equity owners' stock and over for sale. We next to the next, it is about best practices to avoid behavioral bias. So there is two strategy in these practices. The first is strategy using a rules-based investment process. There is a passive index and quantitative investing. The simple, straightforward way to avoid investment bias is to remove the role of the human decision maker from the examination of individual investment opportunities by employing a predefined set of criteria that are automatically implemented. This formulatic technique necessitates the investor establishing objective criteria for favorable investment outcomes in advance. This type of investment is highly common nowadays, and the majority of stock market turnover can be attributed to some variation of a formulatic method. So guys, I think that's all from me. Sorry for all the mistake. Assalamualaikum warahmatullahi wabarakatuh.